conducive environment for private consumption to pick up, which we expect would be in the second half around the 7.8%, and the government consumption growth is also pegged by our house view at about 6.1%. Now, we have seen that the manufacturing PMI remains strong in the expansionary zone, and the services PMI also above 60 continues to be in the expansionary zone. We do need to watch out for the external challenges, unevenness in private capex. Some of those factors pose risk which need to be closely watched. Now, getting to the bank's numbers in the quarter that you have seen, the advances under management at 26.8 trillion rupees grew 6.1% over prior year, and on an average AUM basis grew 1.86 trillion rupees, 7.6% versus prior year. On the deposits front, the total deposits reported rupees 25.6 trillion grew year on year by 15.8%. On an average basis, also it grew 15.9%, 3.36 trillion rupees. Sequential quarter, on an average basis, we grew close to 1 trillion, 0.99 trillion or 4.2% growth, and powered enormously by the time deposit, which grew year on year by quarter on quarter by 0.9 trillion on an average, 5.8% growth. That's in terms of the headline volumes. On the distribution expansion, we grew 51 branches in the quarter and 1,052 branches in the last 12 months. And this year in 9 months, about 405 branches or so. So we continue to expand our points of presence. On the payment acceptance points, we have 5.4 million, a growth of about 12% since last year. On the customer franchise addition, we added 1.9 million new liability relationships in the quarter. Our customer base stands little above 96.7 million customers. We also added 1.5 million cards during the quarter. The total card base stands at about 23 million. We have a strong balance sheet with a total capital adequacy ratio at 20%, CET1 ratio at 17.3%, so 17.5%, and the LCR quite strongly positioned at 125%. Now, getting to the revenues. Revenues for the quarter at 421 billion grew 6.3% over prior year. Net interest income at 307 billion, which is 73% of the net revenues, grew 7.7% over prior year. The core net interest margin was at 3.43%, and the core net interest margin on an interest earning asset basis is 3.62%. Now, getting to the other income, aggregating to about rupees 115 billion, within that it comprises the fee and commission income, which is 71% of the total other income, at about 82 billion rupees, grew 17.9%. Similarly, the foreign exchange earnings and derivatives income at 14 billion grew 16.5% over prior year. Now, getting to the expenses, expenses for the quarter at rupees 171 billion increased to 7.2% over prior year, and cost to income ratio was at 40.6%. Now, getting to asset quality, the GNPA ratio was at 1.42% compared to 1.36% in prior quarter. This includes the impact of the agricultural segment, which is seasonal between the Rabi and the Kharif crop season, so the December season gets impacted. So GNPA, excluding the agricultural segment, at 1.19%, remained flat to what it was in the prior quarter at 1.19%. Now, getting to the slippage ratio, the slippage ratio in the current quarter at about 35 basis points compares to 88 billion rupees or so, and it's excluding the impact of agri at 26 basis points is flat to prior quarter. Now, getting to the total provisions for the quarter at rupees 32 billion compares to 42 billion in prior year or 27 billion in prior quarter. Again, impact of the agri. Excluding agri, the credit costs have been fairly flat quarter to quarter. You know that we do have floating general and contingent provisions, which account for almost 169% of gross non-performing loans. And on a basis point basis, floating contingent general provisions are about 1.43% of gross advances as of quarter end. Now getting to profit after tax at 167 billion, grew on a reported basis 2.2%. But as you know, last year we did have tax adjustments and treasury items and net mark-to-market trading gains. Excluding those one-offs, the profit after tax grew by 13.6% versus prior year. Now, getting to in summary, the results reflect robustness in various parameters, passionately driven by our employees. We are progressing in our journey to normalize the CD ratio with the deposit growth outpacing the loan growth, which I just described above. We have seen robust growth in our average deposits close to 16% year on year, and the AUM growth close to 8% year on year. We have delivered the strong deposit growth despite the challenging macro environment, which again, system liquidity being neutral to negative through the quarter. NIM remains in a very range bound with an upward bias. Opex continues to be managed very tight at cost to income ratio at about 40.6%, despite our franchise continues to demonstrate strong deposit growth, which Opex growth of 7%, deposit growth of 16%. Credit parameters continues to be pretty stable, and we are robustly positioned, growing in a very balanced manner, and get the strategic imperative to rein in our CD ratio. We have sufficient liquidity as well as capital and continue to grow our deposits, allowing us to be in a comfortable position to grow and capture market share in advances when the macro turns favorable. So with that, maybe I stop here and open it up for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Please note, participants are requested to restrict to 2 questions per participant. Kindly join the queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vishwanath Nair from NDTV Profit. Please go ahead.
Hi, sir. The first question is with regard to the net interest margin front. If you can explain at what point in time this contraction is likely to end, considering specifically that there is going to be a rate cut, or is the expectation of a rate cut is very high at this point. And the second question to that is also, while I understand agri slippages have added to the NPA for this quarter, CRB slight 1 basis point is a very small number, but on the base it looks larger. So just want to get a sense as to where those slippages are coming from.
Okay. Two aspects of it. One on the margin. See, one thing on the margin is that it has been fairly stable compared to various industry players that you have seen or you will see, which is how, because of the positioning, the duration, the modified duration of the assets and the modified duration of liabilities are fairly matched, very closely, tightly together. There is an impact on the rate, right? When the rate does change, there is a lead and a lag effect, but then that is a quarter-to-quarter effect, not an annual effect, because they stabilize over a period of a year. So that's one on the margin as such. Otherwise, we are positioned in a way that CASA, hopefully, as you alluded to, when the rate changes, the preference of customers today has been more towards time deposit, wanting to lock in little higher yields. We should see that, which is what we have seen over the last 2 or 3 large cycles over 10 years. We've seen the customer preference also moves into the CASA area, and that also provides a tailwind there. So that's one on the margin, right? So we'll have to wait, and both customer preference plays out, as well as not quarter to quarter, but over a period of an annual year, if you see that the bias is to be stable to moving up. Now, the second aspect of it you touched upon on the NPA as such. On the NPA, what needs to be seen is that the overall NPA at 1.42, excluding Agri 1.19, it's flat quarter to quarter. It's been pretty stable between that. And then the next other important thing is to look at the slippages, how accounts slip into non-performing. That also, if you look at it excluding Agri, because you know that in December and June, you get that impact of the seasonal, the crop season impact that you get. But excluding that, it is flat, 1.02 to 1.02, both sides. And similarly, on the credit cost also, when you look at the total credit cost at 50 basis points or net of recoveries 36 basis points, it is pretty flat excluding Agri. It's either 42 or 36, whichever way you look at it, excluding Agri, it is also flat. So it's a function of the seasonality of Agri that will have to play out, which has played out. Other than that, every other portfolio groupings that we have, the retail book or the CRB book excluding Agri, or the non-retail book, all of the corporate wholesale book, all of them are pretty stable over this time period. And you alluded to a basis point or two on CRB. Yeah, see, 1 to 2 basis points can always move at any point in time. Those are normal in terms of how things happen. And again, how many festival days were there and how many working days. I don't want to go into those kind of minutiae. There are several factors that go, but a basis point or two left, right, that doesn't change the fundamental construct of the quality of the book that continues to be pretty strong.
Sorry, just if you allow me a follow-up around the margin question. Now, your advances get repriced faster than your deposits. So while I understand the customer preference will change, but in the short term, will there likely be any changes?
Quarter to quarter it will be, but I would urge you not to look at quarterly because that's not how we manage. We have to manage it over a period of at least annual and longer. And so that is how the book is positioned, not for quarterly changes, but for how do you manage it over a year.
All right, sir. Thank you. I'll come back.
Thank you. Thanks.
Thank you. Next question is from the line of Piyush Shukla from Hindu Business Line. Please go ahead.
Good evening, sir. Am I audible?
Yes, please. Good evening.
Yes, sir. Sir, Opex is a little bit higher as we are continuously investing in building retail franchise. Want to get some guidance for the current year as to how many branches will you add? What would be the impact on your Opex because of that? How much will it rise? And secondly, sir, you alluded towards higher seasonality impact in this asset quality, particularly in agri loans. Going ahead in the current year, if you could give a broader assessment as to how these last year unsecured segment was a bit under pressure, MFI segment, unsecured personal loans, so on and so forth. So at HDFC Bank, how do you see the asset quality panning out in the current calendar year and in general also in industry, what are the trends that you're seeing, sir? Thank you.
Yeah. More than giving you an outlook of looking forward, I will tell you where it stands. That gives you the level of comfort, how we manage and where we are positioned, both on the cost as well as on the credit. Getting to the cost first, expenses first, right? For the quarter, 171 billion rupees. Cost to income ratio 40.6, stable one period to another period. And the rate of growth year on year 7.2%, or quarter to quarter 1.3% change, right? Which we believe that is one of the levers that is strongly positioned expenses. And more important on expenses is also if you look at cost to assets at 1.93 thereabouts is one of the best in class in the industry. If you compare us to any of the private sector or the industry average, at 1.93 or thereabouts on the cost to assets, expenses by assets, is one of the best in class. So highly efficient. And you touched upon the investments in branches. Yes, we do make investments in branches to expand our distribution reach, because that's the fundamental tenets of how we acquire and engage with customers to manage them for better relationship. And as we grew 51 in this quarter, 405 this year, there is no one particular target or outlook that we have provided, right? The last year we grew close to 1,000 branches. This year so far 405 branches. Where we will end, we will not get the particular outlook, but then our trajectory is to make certain investments to reach. But it is not for eternity, in the sense that we evaluate it periodically in terms of how many we need, and then you take a pause to drive the productivity of those, so that both the employee productivity as well as the engagement with the customers, the reach to the customers happen. And one other important aspect of all of this is, once you get those branches and people and get the reach, you need to get on with customers. So we have added 1.9 million customers in the quarter. Similarly, last quarter was about 2 million or thereabouts. And last year, whole of last year, we added 9 million customers or so. So we keep bringing on. Now we have about 96.7 million customers to work with to deepen the relationship. So that is how you perceive. So there is no one particular number, but that's part of how we manage. And we do see that the density of branches in the country is half the level of what you will see in a Western market. So we do see that the country does need more distribution presence points to be closer to the customer for better engagement. So that's one. Without any particular number of an outlook, I just gave the fundamental tenets of how we operate on that. The second aspect of it that you asked about is the quality. Yes, I alluded to say that other than the seasonal agri, the overall portfolio is pretty strongly positioned, both from a GNPA point of view, the leading slippage also remaining flat, and thereby the credit cost also remaining flat from last quarter to this quarter, if you see, have been stable. Then you alluded to see that like last year, the unsecured or the MFI and so on, those kind of portfolios, we are the leading players. We are one of the largest, or I would say arguably the largest market share in the unsecured book between cards and personal loans and so on. Those books are all pretty stable and very strong at an aggregate level. And we do have that SLI MFI, but they are a small portfolio in the overall scheme. But including that, you can see that there is no particular change or blip in any of the NPA numbers or credit cost numbers, because the way we approach it is with the financial education preceding any lending, and we have more than 10,000 people hand-holding and working with these kind of customers. You know that our SLI book is 100% women folk. That means in the rural, it is given to women for production. That means various products they produce, right? That's the target at which we operate, and they are closely coordinated to ensure that the outcome is perfect. And that is how what was important in terms of giving back to society through these social initiatives. We continue to do this operation and successfully manage the credit quality there. Thank you, sir. I'll come back. Thank you, sir.
Thank you very much.
Thank you.
A request to all the participants, kindly restrict to 2 questions per participant and join the queue for a follow-up question. Next question is from the line of Siddhi Naik from Thomson Reuters. Please go ahead.
Hi, sir. I have a couple of questions. Am I audible?
Yes, good evening. Audible, yes.
Hi, good evening. So my first question is on your slippages aspect. Excluding agri, I guess slippages are at around 65 billion. If you could also give me a breakup of how much of it has come from MFI, credit card and TL. If you could provide that breakup, please.
No, we don't provide that, but we annually publish in our US filing. You will see certain numbers there. But on a quarter-to-quarter, we don't. But all I will tell you is that at an aggregate level, you've seen that 64, which is stable. And that includes all of those books. That includes the unsecured book as well as the credit card book and the SLI MFI book, all of them. And they're pretty stable.
They say fortune favors the prepared. The more prepared you are using the tools of technical and fundamental analysis, the more returns you can make at the markets. Join me, Gautam Shah, at NDTV Profit's special session for investors. See you there.
I present the budget for a historic
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme, as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the Finance Minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Hi, I'm Alex Matthew and we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Managing credit is tricky. Over the last few months, even the Reserve Bank of India has had to step in to tell lenders to be careful about giving out personal loans. The reason is that there's been a rise in bad loans. People are unable to pay back their debt. The thing is, not paying back a loan can have a cascading effect. It can even push someone into what is called a debt trap. How does this happen? And what should you do if you find yourself in such a situation? Joining me to talk about this is credit expert Parijat Garg. Parijat, thanks so much for taking the time. It's an important conversation to have because sometimes people don't realize it's a slippery slope, and by the time they've realized that they're in trouble, it's often too late. So what are the first few signs, in your opinion, that things are not going well when it comes to managing credit?
Thank you, Alex, for having me here. And it's a very important topic, that trap where one gets into a vicious cycle. And the first red flag that one can spot is that if you have to take a loan to repay another loan, that itself is the first big indicator that you are progressing towards a debt trap. And usually what happens is that you will be taking the next loan with higher interest rate, perhaps from an institution or from informal channels, and that creates a spiraling effect for you. The second possibility could be that you are perhaps taking money from credit cards. Now, a lot of us think that credit card is not loan, but essentially it's backed by credit. And that is a very, very expensive credit. And that is often one of the biggest reasons why somebody gets into debt trap.
So, but Parijat, let's define it first, right? For people who don't understand this concept, what is a debt trap and why is it called a trap?
It's a trap because you go down the path and it's very, very difficult to come out. And why you go down the path? Because if you have taken a loan, and you are supposed to make the payments on a particular time, and if you're not able to do it, you will get penalized for it. You will have late payment charges. There could be other charges that a lender would apply onto your loan, which means that if you were supposed to pay back 1 lakh rupees towards your loan over the next 6 months, now that 1 lakh could eventually become maybe 1.5, 1.6, even up to 2 lakh rupees if you're not paying over the months. And that can become so large that it is very, very difficult for one to even pay that.
Okay.
And to do that, you arrange for funds from other sources. And at one point in time, you will run out of your sources to get money. And that is where you're trapped in obligations towards many, many different lenders, which could be formal lenders, informal lenders, and it's very, very difficult situation to come out of.
We saw a lot of people face this problem during the COVID-19 pandemic, and this is because a lot of people lost their jobs, their livelihoods, and they had existing credit or they had existing loans. And what the government did and what the Reserve Bank of India did at the time was to give a moratorium, which is they said you can avail of this and you can delay your payments over a period of time and then restart paying. But of course, that is not available right now. So in a situation where people find that they're in this debt trap, the avenues to escape are less. But does this often happen, Parijat, with unsecured credit, which is personal loans, credit cards, and the like? Even BNPL, which is essentially the same thing, right? You're taking credit. Does it happen more with that, or does it happen with things like housing loans or car loans or things that are backed with an asset?
So in our world, we call loans in two categories: good loans and bad loans.
Yeah.
Now, good loans are the ones which are backed by assets where there is a value associated. So in case you are in trouble, you can sell that asset and recover the money and repay your loan. Or that asset is generating revenue for you or some income for you. And the backed loans are the one which are purely for consumption. Maybe you're buying a luxury good or you're actually investing in your wants. And that is where possibly you would find more debt trap situations in comparison to the secured loans like home loans or vehicle loans. Having said that, it is not that you cannot get into a debt situation even when you have taken a large loan, which is for, say, an asset. It could happen in emergency situations or unexpected situations. So maybe, like you said, COVID is one example. A lot of people get into such traps because of medical emergency, which you have not planned for and which you are not aware of. And that could lead to crumbling your finances. Now, in such situations, one need to really go out all out and spend a lot of money on family's health, and you are completely short of money. So these could be situations which are unavoidable, and it could also create situation. But more often than not, it's unsecured loan, which are towards consumption, towards your wants or desires, which can be somewhat controlled. And that is very important when one needs to come out of that trap, which is discipline.
We'll talk about how to extricate yourself or get out of such a situation. But Parijat, you speak to a lot of people, you help a lot of people with managing this very situation, and you've seen some of these situations develop while you're trying to help them. Can you talk about some of the most vivid examples of something like this happening?
Yeah, so I think I can maybe quote 2 or 3 different examples. One, I like one of close acquaintances. That person took money not just from banks and NBFCs, but also from family and friends. And the money was taken to make investments. Now, we have seen that over past few years, the investment has been giving a lot of good returns. Maybe people are able to make 20-30% year on year on a good investment. Now, it works very well because you might be taking loans at 15-16% and you're making 30% and you're able to repay those loans. But that is in good situation. What about now? Like what we have seen over last 3-4 months, when the market is not helping such investments and you can't take the money out, or if you are going to take the money out, it's going to be at huge loss. And this person is now struggling to repay the money, repay the loan. And since the money was in a large quantum, it is very difficult because it's actually adding up, both in terms of interest rates and penal charges. And it's very difficult to repay money in this situation. That is one. Second one was an example where it's a low income example, where the person's income was about 50,000 rupees. Now, one of the kids was critically ill, and the amount of expenses were surpassing 10 lakh rupees. Now, in this situation, the family did not have any health coverage. And this money was taken again from banks, NBFCs, pledging gold, whatever was there in the house. And so the family is full out. How does one recover from that situation when your annual income itself is just about 50-60,000 rupees? So in this example, perhaps, like if there was enough insurance available, that could have been a possibility. Or if there was a possibility of solving through crowdsourcing, where you're able to take help from public at large and recover that money and come out of that debt situation. So there are quite a few such examples. COVID was another example where I saw a lot of people coming across because they had either lost jobs or they had invested in businesses, which the businesses were shut down. So they had taken loans to run businesses. Now the business itself is not taking off because of COVID situation. Now, how do you recover money? How do you earn money? And how do you repay the money? So all your assets are kind of locked up and you can't recover money and you can't pay their money. And these, like the situation that I'm talking about, could be for about 10 lakh rupees for a low income group person. For a high income group person, this could be 50-60 lakhs, 1 crore, 1.5 crore kind of debt traps as well. So it is not a situation which is affecting only a certain segment of people. I've seen it all across.
I've seen this happen as well. Somebody who works with me had to take a loan from a loan shark, Parijat, you won't believe it, for their daughter's wedding. And they were borrowing at 10% per month. And so that has amounted to a very large amount of money. 3 lakh rupees was borrowed. So she was paying back 30,000 rupees per month. And in the first month itself, it's not like she got 3 lakhs, she got 2.7 lakh. So the interest for the first month was taken, and that, as I understand, is how loan sharks work. But that is a really horrible situation to be in. What are the first few things that happen when you miss a loan payment in the formal sector, when an NBFC or a bank has given you this loan? When you miss, what happens?
So the first thing that will happen is you will start getting calls for collections, and they will be a lot more polite in the first few calls. They will try to understand, they will try to nudge the customer, understand what's happening in their lives, and give them opportunity to repay. But as the situation progresses, and if it seems to get worsened, then you will start seeing collection agents coming at your doorsteps. Now, regulator has definitely taken a lot of steps in terms of making sure that this does not go into very difficult situations for the customers. But still, somebody showing up at your doorstep asking for money is not a very pleasant situation from a social context standpoint.
Okay.
And that starts to put a lot of mental pressure on people. People go through a traumatic situation, and we have seen people losing lives as well when the money surmounts to a level where they can't really look out for it.
Yeah, and the other thing that happens, of course, Parijat, other thing that happens, of course, is that your credit score gets hit immediately. And whenever you have to go out and take more credit, which is often what people do, then it becomes much more expensive to do. So the final leg of this conversation is, how do you get out of a situation if you are in such a situation? And what, according to you, are the first few steps, or all of the steps that you have to take?
Sure. So I think, like you rightly said, credit score gets impacted, and that does not allow you to take more loans or loans at better interest rates. So that really puts you into that trap. So I think the first critical element is to spot when you're going into this situation. More often than not, I've seen people coming and realizing this very, very late. And even if they seek any professional advice, it's very difficult at this situation to advise anything because the person has already exhausted most of the avenues. So it's very important that one understands, first of all, that they're getting into a debt trap, which means that you are possibly taking more loans than what you are expected to take. So if your income is, say, 100 rupees, don't let your EMIs cross more than 40 or 50 at worst. Because if that is getting crossed, then you are possibly likely to move towards debt trap. So that's the first indicator that one needs to keep in their mind. Second is that if you realize that you're getting into debt trap, go and seek professional advice. Do not try to exhaust opinion or avenues yourself, because it's possible that you may not make the right choices. You might be making choices